Trying to make sense of the financial markets, it can feel like you're wrestling with this giant, chaotic beast, right? But what if I told you the real enemy isn't the market at all? What if it's, well, us, our own human nature? That's exactly what we're diving into today with Benjamin Graham's masterpiece, The Intelligent Investor. This isn't just about picking stocks, it's about a philosophy for mastering ourselves.
So that quote, it's about Sir Isaac Newton. Yeah, that Sir Isaac Newton, one of the smartest people who ever lived. And you know what? He got absolutely wiped out by the South Sea bubble. Here's how it went down. He invested, made a nice profit, and got out. Smart, right? But then he watched his friends keep making money, getting richer and richer, and that fear of missing out, that FOMO, it just ate him alive. So he jumped back in, right at the very top, and lost everything. I mean everything. It's just the perfect, painful example of what Graham is talking about, this epic battle between our rational brain and our emotional gut.
Okay, so how do you actually win that inner battle? Well, for Graham, it starts with a really fundamental question you have to ask yourself. And no, it's not about how much risk you can stomach. It's way deeper than that. The question is, are you an investor or are you a speculator? Because in Graham's world, those are two completely fundamentally different things.
And Graham has a super strict definition for what an investment actually is. I mean, this is his ironclad rule. Look at the three parts. First, thorough analysis, then safety of principle, and finally, an adequate return. If what you're doing doesn't tick all three of those boxes, Graham says you're not doing risky investing. Nope, you're just speculating. Period. So let's break that down a bit. Thorough analysis. That means you're not just buying a stock ticker that wiggles on a screen. You're buying a piece of a real, living, breathing business. You gotta understand it. Safety of principle, that's your shield. It's how you make sure you don't get wiped out by one bad decision. And adequate return, this one's all about your mindset. You're aiming for a solid, respectable profit, like a business owner would. You're not trying to hit the jackpot on the lottery ticket. And wow, this quote, it just perfectly captures the absolute madness of the dot-com bubble back in 2000. The feeling in the air was, this time is different. Old rules don't apply. People thought fundamentals, things like profits, were ancient history. It was a complete and total rejection of everything Graham taught about analysis and safety. And we all know what happened right after that, don't we? The whole thing came crashing down. All right, so if that's the mindset, what's the actual method? This brings us to what might be Graham's single greatest idea, the absolute cornerstone of his entire philosophy, the margin of safety. And honestly, the concept is beautifully simple. Think of it like this. You figure out what a business is actually worth, its intrinsic value. Then you only buy it if you can get it for way, way less than that price. That big discount, that gap between the value and the price you pay, that is your margin of safety. It's not a crystal ball, it's not a guarantee you'll be right, but it's your cushion, your shock absorber for when you make a mistake or when things just go wrong. It gives you room for error. And here's a perfect example of Graham actually doing this in the real world. Back in 1925, he stumbled upon a company called Northern Pipeline Co. The stock was trading for $65 a share. But here's the crazy part. When Graham looked at their books, he saw that the company was holding more than $80 per share in super safe bonds. Just the bonds alone were worth more than the stock price. The market was basically saying the actual pipeline business was worthless. In fact, worth less than zero. That huge gap was his margin of safety. So he bought up the stock, rallied the other shareholders to force the company to pay out the value, and, well, he tripled his money. Not bad.
Okay, so you've got the mindset, you've got the method. What's the last piece of the puzzle? It's all about psychological discipline. And to teach this, Graham came up with his most brilliant and famous creation, a little story about a character he called Mr. Market.
So here's the deal. Graham says to imagine you're in business with a partner. His name is Mr. Market. And let's just say he's a bit of a basket case. Every single day, without fail, he shows up at your office and he shouts a price at you. He'll either offer to buy your share of the business or he'll offer to sell you his. And the price he quotes, it has nothing to do with the business, really. It's based entirely on how he's feeling that day. Some days he's just bursting with joy, totally euphoric, and he'll offer you some ridiculously high price for your share. But other days, oh boy. Other days, he's terrified, convinced the world is ending, and he'll offer to sell you his share for practically nothing. And here is the absolute genius of this whole story. You don't have to listen to him. You are totally free to just ignore him. His job isn't to tell you what your business is worth. His job is to offer you opportunities. When he's panicking, you can take advantage and buy cheap. When he's ecstatic, you can sell to him at a silly price. But the one thing you must never do is let his mood influence your own judgment. The key is this: the market is your servant, not your master.
So there you have it. The mindset of an investor, the method of margin of safety, and the mastery of your own emotions. Now let's wrap this up by looking at why this philosophy, which is nearly a century old, is still so incredibly relevant today.
Just look at this. The comparison is it's undeniable. On the left, we have a company from 1968. It has an IPO. The stock price shoots up based on pure hype, and then, poof, it goes bankrupt. On the right, a company from 1999, eToys. And what happens? The exact same thing. IPO, crazy price surge, then bankruptcy. See? The names change, the technology changes, but that human element, that speculative fever, it never does. And that's why Graham's principles are timeless. They're not about predicting the market, they're about protecting us from ourselves.
And that really brings us to the core question that Graham's entire philosophy forces us to ask. We spent so much time and energy looking for risk out there, in stocks, in the economy. But Graham's ultimate lesson is that maybe, just maybe, the biggest risk we face is staring back at us in the mirror. It's our own temperament. It's whether we have the discipline to resist Mr. Market's crazy mood swings. Because that right there is where the real battle is won or lost.